Hi everyone, I am August Imbrado. I am reporting regarding the summary of the topic Understanding the Basics of Accounting, Finance, Financial Management, and Business Ethics. The role of finance and enterprise. The role of money in the business enterprise can compare to the function of blood in the human body. Money is need to purchase the tools and equipment, materials, and supplies. Function of financial manager. There are two types of function of financial manager. First is treasurership. It is involves provision of funds, custody of funds, or the cashier function, and collection and investment. Comptrollership. Another function is to see to it are effectively and efficient utilized. It involves financial planning, accounting records and reports, tax administration, government reports, internal control. Financial financial planning. It is important because the funds of the enterprise are limited and must be allocated properly to the best interest of the business. Three steps involved in financial planning. First is establishing objectives. This should be clear and specific to determine their cost or budget. Second is budgeting. A budget is an estimated or projected program of expenses and incomes over a specified period. Third, identifying source of funds. There are two ways of financing a business enterprise. First is income from sales. Second is owner's money and sales of the shared stocks. Third, borrowing from friends, relatives, and financial institutions and issuing of bonds. Fourth is sales of some property of the enterprise as a last resort. Use and sources of funds. Funds refer to money or its equivalents which used in obtaining and bringing together resources for the attainment of your business objectives. Use of funds. Assets, fixed assets. Sources of funds are capital, partner capital, stockholder equity, current or short-term liabilities, long-term liabilities financing. Short-term financing, 1 year or less example. Term credit, promissory note, unsecured bank loans, commercial paper. Long-term financing, more than or a year. Example are loans, stocks, bonds. Working capital management. Working capital, it is concerned with the day-to-day financial operation of the business and the problem of ensuring that there is enough cash in the firm to be able to pay what is owed. The accounting equation, stocks, debtor plus debtors plus cash is equals debtors plus borrowing equity capital. Financial record keeping, bookkeeping, book of accounts, income statement or profit and loss statement, balance sheet, chart of accounts. Book of accounts. The journal is a chronological record of the business transaction of the enterprise, referred to as Book of Original Entry. General Ledger. The collection of accounts usually bound different transactions affecting the items in the balance sheet. Financial statements are the means of conveying to interested parties. Balance sheet classifications are assets, liabilities, owner's equity. Valuing assets. Current assets are usually valued at cost. Fixed assets. With most fixed assets except land, it is assumed that the value will diminish over time. Accounting treatment depreciation. The most common method of depreciating an asset known as straight-line depreciation. So this is the formula of depreciation: purchase price residual minus residual value over estimated useful life. Accounting appreciation asset. The increase of an asset is shown that as an underlying value of the business. Cash flow statement. Cash is the most liquid of all assets and the efficient use of one of the most important tasks of the management. Income statement shows the revenues realized by the business as well as the costs and expenses incurred in the realization of the said revenues, also called profit and loss statement. Revenue in a business consists of the sales of goods and services during the period of which statement was prepared. Expenditures consist of production, selling, and office expenses in generating the revenues. These expenditures are cost of sales, sales expenses, general and administrative. Final ratio analysis. The analysis ratio involves two types of comparison. Internal comparison. The ratio can be analyzed from a historical perspective, determining the trend of the ratio and comparing it to expected future ratio for company can assess management and decision making. External comparison. The second method involves comparing the ratio of the firm or with industry averages during a period. Final ratio are classified into five groups: growth, profitability, liquidity, leverage, activity. Common size income statement analysis. This tool reduces or reverts the different items in the income statement into perfection. Break-even analysis is one of the tools used to analyze and measure the profitability of the company. Management can utilize on their operations such as a lower performance compared to the expected volume of sales, an increase or decrease in the selling process, the hiring of additional salespeople, an increase in the wages of labor, the rise in the cost of raw materials, other factors affecting cost, volume of sales, and production and selling prices. Classification of cost. First is fixed cost. Fixed cost are those costs that remains constant regardless of the volume of production. Variable costs are the costs that vary directly with the level or volume of business activity. Budgeting. A budget is business plan expressed in terms of money and units of a definite period of time in the future. Cash management. To keep business going, it must have sufficient cash readily available for its immediate needs. There are two primary objectives in cash management. First is provide adequate cash to meet the needs of the business. Second, safeguard cash from loss due to theft, fraud, other criminal manipulations. Provision adequate cash to meet the needs of the business. In order to meet the cash requirements of the business, you have to determine the expected cash to be received. Planning cash requirement. Your sales forecast may be done on a daily, weekly, monthly, or yearly basis. It is easier for you to make estimated daily than forecast your sales from day to day. Cash budget. Steps and preparation in cash budget. First is estimated cash flows. First, estimate the sources of cash inflows, sales of products and services, additional investments by owners, proceeds from loans, collection of receivables, and estimated amounts received. Second, estimated estimate cash outflows. The following are the anticipated disbursement to be considered in estimated cash outflows: cash purchase, payments of credit purchase, administrative selling and overhead expenses, payments like rentals, insurances, loans and interest, taxes, dividends or personal drawings of owners. Third is compare cash inflows versus outflows. A detailed month-by-month comparison would be determine the future surpluses and shortage of cash. Preparing the daily cash report, another tool to provide information on current cash position and in turn to ensure that there is enough cash to meet the needs of the business. Dealing with cash shortage. If cash budget shown certain shortage, it is time to look for sources for additional cash, first from internal sources and if this is not sufficient from outside sources like banks and other financial institutions. Dealing with excess cash. In this way, the money is not kept but used to earn additional return. Monitoring and controlling the cash budget. Monitoring is also another aspect of cash management. Safeguard from Safeguard cash from loss. To safeguard company's asset and internal control systems employs automatic check and balance by requiring that the work of one person is reviewed and examined by another. Business ethics. Ethics is the study of right and wrong. In 1977, General Assembly Bishop Business Conference of Human Development. Peter Drucker is an international famous management consultant. A code of committee was entrusted with the task of researching the latest thinking on social responsibility of the business. In restructuring the code, the committee focused attention on six critical areas of business responsibilities. First is employees, second, customers, third, shareholders and other provider capital, fourth is local, five, national government, and six, society in general. A code of ethics for business. This is a code of ethics has been formulated and built by the belief that man has a dignity that must be respected and that all the resources of the earth have been created for him and developed. The concepts of code of ethics for business towards the employees, towards the customers, towards the supplies, towards the owners and other providers of capital, towards local and national government, towards society in general. Some ethical principles for the professional management, the concept and the principle of for the conduct of business outlined in this document are commended to the managers of the business enterprise. And that's all. Thank you.